Sprint 23. How high-risk entrepreneurs fund their startup. While most entrepreneurs are bedrock, many start by dreaming of being an entrepreneur that founds a company that quickly becomes worth a lot of money, perhaps even more than $1 billion. This sprint describes the realities and the challenges faced by high-risk entrepreneurs in finding investors for their startup. We describe the keys to getting funding from angels, being accepted by an accelerator with a good track record, and ultimately getting Series A funding from a VC. We also go over the numbers of how few entrepreneurs succeed in getting to Series A. How high-risk entrepreneurs fund their startups. Written and read by Derek Lidow.
High-risk entrepreneurs want to take their ideas and make them as impactful and valuable as possible, as fast as possible. Failing is not a big deal because high-risk entrepreneurs feel that failing gives them an additional experience, which just improves their odds of succeeding the next time. While many entrepreneurs dream of going down the high-risk path, few actually do. As we mentioned in the previous sprint, less than 3% of all founders wind up going the high-risk route. A critical starting point for even considering the high-risk route is that you have to be prepared to give up control of your startup. Strangers that invest in your startup want their money back. So they only invest in startups with credible plans to either be sold or to go public within 5 to 10 years. They do not invest in startups that plan to stay private and pay dividends to their investors. They want to invest in ambitious founding teams who want to make as much money as possible in as short a time as possible. It doesn't matter to them who is leading the startup just because they came up with the idea. There are 3 main groups interested in funding the startups of strangers: angels, accelerators, and VC. Angels. Angels are wealthy individuals who take pride in their ability to help ambitious entrepreneurs start companies. They invest in entrepreneurs that they like and who are starting companies that they think they understand, and where their understanding tells them their investment can triple or more in value over the next few years. In the U.S., they tend to individually invest on the order of $25,000 to $250,000. Often, angels invest together in groups, which can result in a group of angels investing up to $1 million at a time. The latest data shows that the median angel round in the U.S. is a modest $88,000. In other countries, these amounts are considerably less. Less than 1 in 5 companies receiving angel funding go on to receive VC funding, and more than 70% of all angel-funded companies fail. A small sliver of angel-funded companies prosper, having only received angel funding, and where the angel winds up receiving dividends from their shares. Angels are individuals to whom investing in startups gives them pleasure. For some, it is just the pleasure of making money, but for most angels, it's about feeling relevant and respected. Many angels accumulated their wealth as successful entrepreneurs and want to feel that they're still part of the entrepreneurial ecosystem. This pleasure can come from investing alongside other angels and groups, or when they invest alone from getting to know and helping an ambitious entrepreneur. When a founder receives money from an individual angel, they should expect that the angel will want to feel involved and will require ongoing attention to make them feel appreciated and relevant. When you introduce yourself or describe your startup to a potential angel investor, you want to make it clear how what you want to do is inspired by what the angel has done or is interested in. We will prepare sprints specifically on how to pitch to angels in the near future. Accelerators. Accelerator is a general term for organizations that explicitly help founders start their companies. While some people use the term generically, you will want to distinguish accelerators from incubators. Accelerators give space, training, some investment money, as well as access to their commercial networks in return for an equity interest in the startup. All accelerators offer to introduce startups to potential investors, but they do not promise that any will invest. Prestigious accelerators like Y Combinator virtually guarantee their graduates will receive seed funding once the program ends. On the other hand, incubators do not invest and instead charge startups for providing space to work, where that space provides access to a local entrepreneurial ecosystem. Accelerators are businesses who want to make money from helping startups succeed. Because they invest in and own equity interest in startups, they select their cohorts of participants based upon what they feel the chances are of the applicant getting sold to a bigger company or perhaps going public sometime in the not too distant future. Without fairly quick liquidity from their investments in the startups that they nurture, an accelerator will run out of money and close, which actually happens to most of them. Prestigious accelerators are very selective in whom they admit, and they only accept teams and not individuals. They invest between $100,000 and $500,000 for 10 or more percent ownership stake. They also help put together post-graduation seed rounds of several $1 million. There are maybe a dozen prestigious accelerators in the world, and they greatly improve high-risk entrepreneurs' chances of being successful. Most other accelerators offer to make small investments and have spotty records of helping their graduates find seed capital. For first-time founders, getting accepted to a credible accelerator program is a critical step on the path to getting significant outside funding. Accelerators give first-time founders credibility because the former entrepreneurs that run accelerators basically vouch for the entrepreneurial savvy of some or all of their graduates. About 1/3 of all startups that receive Series A funding graduate an accelerator program, with 1/3 of that total coming from just the top 5 accelerator programs in the US. When you consider that most Series A funding goes to startups led by individuals who spun out of existing successful startups, or are serial entrepreneurs, or are individuals or teams closely mentored by a well-connected, successful entrepreneur, it is clear that being accepted and graduating with sponsorship of a credible accelerator, particularly a prestigious one, hugely increases the chance of a first-time founder being able to raise significant amounts of venture funding. There are a couple hundred real accelerators in the US at this time, and around 500 or so worldwide. But the majority of accelerators who invest money, space, networking time in 2 or 3 cohorts of teams per year are not successful at helping many of their startups to get to Series A. Many organizations that call themselves accelerators actually charge for their services, and we would call them an incubator. And they're not very useful in helping entrepreneurs raise money. Aspiring high-risk entrepreneurs, therefore, need to investigate and verify the track record of any accelerator they consider joining. In a future sprint, we'll give more details on when and how to apply to prestigious accelerators. VCs. Venture capital, or VCs, are organizations created for the purpose of investing in startups and non-public companies. While there are different flavors of VC, each with slightly different business objectives, the classic VC is a firm founded by an entrepreneur for the purpose of investing in startups with the goal to make a much greater return on investment for their investors than the investors could make in public equity markets. In return for getting a higher than market return for their investors, a typical VC charges 2% per year for managing the investor's money and also receives 20% of the profit they make for the investor. Since giving money to a VC firm to invest on your behalf is expensive, successful VCs must have track records of investing in startups that get big fast. The first serious round of VC funding is known as Series A. And for the past 40 years in the US, there have been around 1,600 unique startups a year that receive Series A funding. This number does fluctuate from year to year, and the size of typical Series A investments has grown considerably over that time. But the count of unique startups getting past Series A hasn't changed much in 40 years. Realizing that in the US, there have been around 800,000 new businesses incorporated a year, you can see how extremely picky VCs are about whom they give substantial amounts of money. How big you have to get fast depends upon the VC. Commonly, VCs want to invest in companies that will get at least as big as half the size of the funds they manage. If the fund is managing a fund with $100 million, they will want to invest in companies that can be sold for more than $50 million in 5 years or so. And they will want the company to get that valuable with around $5 million of total investment. Furthermore, many of these $100 million funds do not want to invest in risky startups at all. Instead, they invest their money alongside bigger VCs investing in already fast-growing, bigger companies. The universe of VCs wanting to invest in companies with the potential of becoming fast-growing, very profitable $50 million companies is pretty small. Investing in first-time entrepreneurs, particularly without any relevant industry experience and connections, is super risky. So scoring such an investment requires strategic cultivation of contacts with VC firms that might someday be interested in investing in your idea once you prove that it will be super fast growing. This is what accelerators help you do. If you have industry experience and if you know your potential customers well, then it can make sense to introduce yourself directly to VCs that have experience in investing in related businesses of the size you aspire to get to in a few years. The realities of high-risk entrepreneurship. The reality is that there are many people that dream about being a high-risk entrepreneur, but few, very few, actually follow through. Here are the underlying numbers. There are over 36 million entrepreneurs running their own businesses in the US right now, and another 12 million people working on their ideas and aspiring to be an entrepreneur. 30 million are solopreneurs and have no employees, although many use contractors to support them with specific business needs. Close to 6 million different businesses with employees operate in the US. 99% of those are run by entrepreneurs and not listed on a stock exchange. There are about 3 million new businesses, including solopreneurs, a year, and about the same number of that close up shop or give up or are sold in a year. Of these new businesses, about 50,000 get some angel funding, of which approximately 12,000 or so will succeed in starting up and being sold, and maybe 1,000 of those will get to Series A. Around 2,000 attend an accelerator, of which maybe 600 get to Series A, The other 1,000 a year that get to Series A do not go through an accelerator because they're started by individuals with specific industry expertise or by serial entrepreneurs, many of whom receive some initial funding from an angel. The reality is that it is very risky to want to be a high-risk entrepreneur.
Sprint exercise. We first ask you to read or listen to how high-risk entrepreneurs fund their startups. Then, for the exercise, please estimate. How many months will it take for you to hit $50 million in revenues? How much investment will it take you to get to $50 million in revenue run rate as fast as possible? What strong evidence of big demand do you expect to be able to show angels or VC investors to get them interested? And lastly, who will be on your team and how will your team inspire confidence in angels, accelerators, and or VCs that you can hit your goals?